Hey guys, welcome to another episode of Smart Risk. Understanding the liquidity concept will instantly improve your entries and exits, help you to run into a lot fewer losses, and allow you to catch insane risk-to-reward ratio trades. In this video, we will explain the powerful concept of liquidity from smart money trading perspective. We will show you which moves are liquidity grab and how to apply this concept on the chart. And finally, our key and rule-based liquidity trading strategy with specific entry and exit points. So guys, if that's something you are interested in, click on the like and subscribe buttons to show your support, and I will see you after the intro. So what is liquidity? Liquidity basically means money. Every trade is a transaction between the buyers and sellers. So more money in the market makes it easier to trade for big players. Suppose a huge company needs to exchange hundreds of millions of dollars into euros, and if they do this when liquidity is low, the price will skyrocket. They don't want to increase the price because they simply want to buy cheap. So, they need liquidity, or in other words, they need sellers in the market. So, the question is, where are the liquidity zones? Liquidity is where retail traders get involved in the market. We know that if price makes it to this demand zone, traders will get involved with buying pressure, and it is not just retail traders. It could be small banks, private institutions, etc. So if they place buying orders here, their stop losses are sells. Hence, the liquidity zone is below this demand zone and the condition is ready for the company to grab the liquidity, and then the price makes a sharp move to the upside. Here on the top, when the price reaches this trend line, it acts as support. So, traders will go long when price touches the trend line and place their stop losses below the line. So this is our liquidity zone, and below that we have a major level of structure that has recently acted as both support and resistance multiple times. Suppose the price reaches this major level. In that case, it will give us a perfect trading opportunity to go long because grabbing the liquidity will provide the conditions for continuing the price trend, which is precisely what we would like to see. What are the benefits of identifying liquidity zones on the chart? First, an existing liquidity zone, before a demand or supply area, makes them a perfect trading opportunity because liquidity acts as fuel for the movements we want to see in the market. The second benefit of identifying liquidity zones is that you can distinguish liquidity areas with a less chance of working from major demand and supply zone. This helps you promote your entries and run into fewer losses in your trades. Here price broke through the structure level with inefficiency, leaving behind a perfect order block. So, if the price gets back to this area to fill the gap, it would be an excellent opportunity to place buy orders. After this sharp move, the trend got exhausted, and see how many times it created liquidity zones. After that, the price broke the support levels, it took out early buyers, grabbed all the liquidity, and continued moving to the upside. So here is an important point. Grabbing the liquidity before reaching an order block makes it a perfect trading opportunity. But it is not a law. Because price can easily break through the order block and lead to a major trend change, so that is why we always look for a reversal pattern on lower timeframes before placing the trades. The types of liquidity on the chart. There are many liquidity zones, like trend lines, consolidation areas, even major moving averages, etc., but we mainly pay attention to equal highs and lows. We want to keep things as simple as possible and be able to use this concept for our benefit. So, look at this example. This is how we distinguish major supply and demand levels from liquidity areas. Starting from the left, we had a nice move to the upside with inefficiency. We would have been waiting for the price to come down and fill this gap and place orders in the order block zone. Here, we had an opposite color candle that created inefficiency, which would have been a perfect demand level for trading. At the top, we had a major level of structure that recently acted as both support and resistance multiple times. Again, a perfect trading opportunity for buyers. Now that you understand the concept of liquidity, let's jump into our key liquidity trading strategy. But before we do that, if you have enjoyed the video so far, please give it a thumbs up and subscribe to our channel since it goes a long way to support us in making more videos like this. This trading setup is not limited to any timeframes and could be traded in forex, crypto, and stock markets. It is really simple, and it consists of two major steps. First, we identify the trend using an exponential moving average. To do that, we apply EMA 50 on the chart and simply need the price to break the EMA in one direction and give us 1, 2, 3 moves, with the third move breaking the structure level. For example, here the price broke the 50 EMA to the upside, made 1, 2, and 3 moves, and broke the previous market structure. So, we have identified that our trend is bullish, as long as we stay above the higher low, and we will only look for buying opportunities. In the second step, we look for a liquidity sweep pattern. It means that we wait for the price to make a support, and either wick below the support and grab the liquidity, or close below the support and get back above. Here, see how the market made support and grabbed the liquidity with this long wick candlestick. So you can either enter right after this candle, or wait for confirmation candle, closing higher than the previous candle. Our stop will be below the long wick candlestick and we will target the next level of structure. You could also make your trade break even by closing half of your position when the price reaches your 1 to 2 target. Here is a key point. Always look at the higher time frame to see where the price is and how much room it has to reach the next level of structure. For example, this is the same chart right before placing the trade. If we zoom out to 1 hour's time frame, we can see that the price has recently broken the structure to the upside and it has a lot of space to go until it reaches the next level of structure. Also, if it breaks the higher low to the downside, we will look for shorting opportunities in the lower time frame until it reaches the next level of market structure. Keep in mind that everything we discussed applies to the bearish scenario. So let's see a bearish example. Here on the Euro-dollar 15 minutes, we can see that market broke the EMA 50 to the downside with 1, 2, and 3 moves, so we have a bearish bias. After that, market made a resistance and broke it to the above, grabbed the liquidity, and immediately got back to the range. This is also what we call a failed breakout. So, this is when we execute our trade. As I said, this strategy is not limited to any time frame or session, but do your own backtesting to see in which pair it works best. So guys, I hope this video has been useful to you. If it has, please click the like and subscribe buttons to help us continue producing more videos like this. Also comment below with your thoughts and questions, since we always do our best to answer them all. See you in the next episode.